The momentum factor is a critical element in predicting stock performance. This explains how momentum investing has proven successful over time, driven by consistent market trends and investor behavior reinforcing these trends. It tackles common misconceptions about stocks at their 52-week highs, debunking the belief that they're no longer a good buy or are more expensive.
Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys.
Quant ratings offer an impartial assessment of stocks, relying on a data-driven approach. These ratings are the result of extensive backtesting and analysis of numerous independent research studies. However, it's essential to note that these factors don't carry the same weight in predicting stock performance. Among them, momentum stands out as the most influential factor, widely recognized as the king among quants. First off, momentum can be categorized into two main types: time-series momentum and cross-sectional momentum. Time-series momentum focuses on a stock's performance concerning its own price history. It often involves buying stocks that break through technical indicators like a 200-day moving average. However, our model doesn't take into account time-series momentum, as it's a factor more commonly used by technical analysts. On the other hand, cross-sectional momentum assesses a stock's performance compared to its peers. This type of momentum helps predict how a stock might perform in relation to its peers in the future. You know that gut feeling when making an investment decision? Turns out emotions significantly sway the markets. An influential paper by Kahneman et al. Suggested that stock prices can either overreact or underreact to information. This insight launched the study of momentum returns, notably observed in a groundbreaking 1993 paper by Narasimhan Jagadish and Sheridan Titman, Returns to Buying Winners and Selling Losers: Implications for Stock Market Efficiency. Their research revealed that buying past winners and ditching past losers raked in substantial abnormal returns. Numerous studies since then have supported these findings. Gexi and Samanoff, 2016, delved deep and found that the momentum effect has persisted significantly since as far back as 1801. Farmer and French, 2008, dug into market factors and confirmed that momentum strategies yield profits even after adjusting for market capitalization and book ratio. Asnes et al., 2014, emphasized that momentum strategies remain profitable even when transaction costs are considered. The momentum factor is a hot topic in finance. Why does this premium even exist? It's largely attributed to behavioral finance. Behavioral finance explains why choosing stocks based on past returns is profitable, pointing to two main biases. Anchoring bias. This bias ties back to investors' reliance on initial information received, like the first stock price. People tend to hold on to that initial number, under-adjusting it when new data arises. For instance, if a stock price rises but its fundamentals improve, investors might still consider it a bad investment because of its increased price. Prospect theory. This theory, discovered by Kahneman and Tversky, uncovers investors' tendency to sell winning stocks and hold on to losing ones, a stark contrast to what standard theory suggests. This bias further supports why momentum continues to pay off in the market. For instance, look at GameStop's skyrocketing surge in January 2021, rising approximately 1,800%. However, despite its momentum, our quant rating system didn't slap a strong buy label on it. Why? Momentum alone doesn't drive our rating system. GME's shaky fundamentals didn't align with its price surge, prompting our model to rate it as a hold rather than a strong investment. Comparing GameStop's rollercoaster ride post-January 2021, crashing from its $483 peak to its current $16 level, it's evident that the quant system flagged it with a low score for long-term momentum. This factor received a rather conservative rating, steering clear of assigning GameStop a strong buy status. On the flip side, Supermicrocomputer, SMCI, showcased a steady, prolonged climb in its stock value, earning a high momentum grade. The stark contrast between SMCI's consistent rise and GameStop's short-lived surge labeled the latter as more of a passing phenomenon. People often question the potential of stocks labeled as strong buys, saying, "It's hit a 52-week high. Surely it's not a good buy anymore." We decided to address this misconception with an article backed by empirical evidence that defends momentum. It's a compelling factor with a robust long-term track record, proving its worth in identifying solid investment prospects. But before delving in, let's define momentum. Now that we've covered why the momentum premium exists, let's tackle the most common criticisms we encounter when we highlight stocks with strong momentum ratings. Once a stock's price has gone up, it's no longer a good buy. Investors often get anchored to past stock prices and underreact to new information. The chart above visually demonstrates that even after a stock has soared, it might continue its upward trajectory. What this feedback overlooks is the importance of considering other crucial factors like improving fundamentals or favorable economic conditions. When investors solely focus on past stock prices and neglect newer information, they might perceive the stock as too expensive or risky, ignoring its potential for growth. Take the case of Powell Industries, Inc., Powell, picked by Alpha Picks on May 15, 2023, when the stock had surged by 56% YTD. Yet on the selection date, its price-to-earnings ratio had decreased, as shown in the screenshot, because its earnings had grown more than its price. This scenario showcases how many overlook the new information regarding increased earnings and the company's momentum in earnings. Seeking Alpha's quant system, devoid of emotional biases, constantly evaluates new data. Since Alpha Picks chose Powell, it has seen a total return of 54.11% by November 30th, 2023. This example highlights the success of momentum investing when applied correctly. Momentum strategies carry too much risk. Every investment factor has its imperfections. While momentum has faced periods of underperformance and crashes, it has stood out in comparison to market, value, or size risk factors in terms of offering investors the highest Sharpe ratio. Per Kenneth French's website, the Sharpe ratio measures return per unit of risk, so labeling momentum strategies as excessively risky seems unfair. Daniel and Moskowitz, 2013, found that momentum crashes usually occur after extended bear markets, mostly impacting the short side of the trade, shorting the biggest losers. During such times, past losers show high expected returns, reversing the momentum effect. However, this isn't equally true for winners during favorable periods, creating an asymmetry in the exposure of winners and losers to market returns in extreme times. Moreover, research like "The Devil in HML's Details" suggests that combining the value and momentum factor effectively mitigates these crashes. As a bonus, the momentum factor has also helped offset crashes in the value factor. I prefer value investing. Understanding the interaction between value and momentum is critical for the success of the quant system. Value holds immense importance, particularly when momentum faces periods of underperformance, as summarized in fact, fiction, and value investing. Value and momentum should be seen as a system, where their combination demonstrates superior strength owing to their negative correlation. This becomes most apparent when value aligns with timely prices. Despite momentum experiencing downturns, let's take a look at value represented by IUSV. Over the past decade, it's significantly lagged behind growth, momentum, and the S&P 500. Value's underperformance doesn't negate its usefulness, though. It's another factor crucially employed in the quant system. Momentum and quant. Let's delve into how Seeking Alpha's quant system utilizes momentum as a factor and how it assists in stock selection. As seen with GameStop, momentum alone doesn't warrant a strong buy rating. After extensive study and testing, our quantitative model on Seeking Alpha identifies collectively robust stocks based on multiple criteria: value, growth, profitability, and revisions. While momentum stands as a vital composite factor, its validation lies in a company's strong fundamentals. This encompasses high-value grades, promising growth potential, sustained profitability, and positive forward-looking earnings revisions. It's crucial to emphasize that the model doesn't rely solely on positive momentum for stock selection. It examines various factors. Consider the case of Supermicro Computer Inc., SMCI, chosen by Alpha Picks on December 15, 2022. At the time of selection, SMCI had a YTD return of 81%. It received a strong buy quant rating because it boasted solid fundamentals across the 5 factor grades: valuation, growth, profitability, momentum, and EPS revisions. Since its selection, SMCI has appreciated by 220.79%. While no single factor or model is infallible, this article provides empirical proof supporting momentum's significance, showcasing its impressive long-term track record and its effectiveness in identifying promising investment opportunities. Wishing you success with your future investments.